From celebrity status investors such as Warren Buffett and Peter Lynch to the everyday investor like myself, stocks have been used as a catalyst for building wealth over multiple generations. With the first publicly traded stock widely being recognised as the Dutch East India Company back in the 17th century. This started as a reason to reduce the risk of sailing across the seas. By investing in only one ship, there was more risk of the voyage failing to bring back the benefits of the West Indies' riches and opportunities. By investing in more ships, investors would still make a profit, even if a portion of those ships failed to return. Today, stocks may not be issued for the same purposes, but allow for the multiple benefits and opportunities for investors who own them. In this video, we'll be looking at what stocks are, why and how they're issued, and the benefits of owning them. If you enjoy what you hear today, please like the video to improve the YouTube algorithm, subscribe if you haven't yet done so, and comment if we've missed anything. To understand the difference between stocks and shares, we'll start with the latter. Shares are a representation of ownership of a publicly traded company or other financial asset that provides a proportionate distribution of profits and voting rights to those who hold them. Stocks are simply a collection of shares from one financial asset, for example, Apple, Alphabet, or Amazon. So how are they issued? Through an IPO, an initial public offering. Put simply, it is the first time a company goes public on the stock exchange. They may do this to raise capital. By selling shares, the company is selling parts of the company ownership in return for funds to reinvest. This could be for new projects and products that will hopefully increase the value of the firm in the future, such as Apple developing their iPhone range. The funds could be used to expand, where they can be allocated to building new factories, headquarters in different parts of the world, allowing for a wider reach. Another reason would be for the owners to cash out. Once the company undergoes its IPO, owners pre-IPO may see an opportunity in selling their shares when the company goes public at a higher price. This does, however, mean they lose their right to claiming dividends and voting rights. The seller of the shares must consider this trade-off before committing to any decision. So now we know what stocks are and the benefits of owning them. We can now look at the variation in this asset class, as there is more than one type of stock. We will cover the main few. A growth stock is considered to produce revenues, profits, and cash flows at a much quicker rate than the market it operates in. A common association with growth stocks is that they do not pay a dividend, either because they haven't actually made a profit yet, which carries a form of risk in investing, or they want to reinvest profits in hope of future company growth. A value stock, on the other hand, is associated with trading at a lower price than its fundamentals suggest. They tend not to have massive growth projections in revenues and profits, but rather have an opportunity for investors to benefit from their lower share prices in hope for capital appreciation. A blend stock has characteristics of both growth and value. They do not generate revenues and profits at quite the rate of growth stocks, but are priced reasonably enough around their underlying value. There are also different ways to determine the category of a stock, mainly through their size and quality. You may hear the terms large, mid, and small cap stocks, which are determined by their market capitalization, or the value of the company. You also have penny stocks that trade for less than $1 per share and are generally considered riskier. Blue chip stocks are companies that are reliable, high quality, and able to survive harsh economic conditions. So this brings us on to why you should invest in stocks. Investors who hold on to good performing stocks can benefit from price increases or capital appreciation. This goes back to the common saying of buy low and sell high. By buying in at a lower price, you can profit from simply holding on to a stock until the price reaches a point at which you feel comfortable selling. But be aware, not all stock prices tend to appreciate. You can also receive dividends, which serve as an alternative source of income. Dividends are simply the amount of profit that companies choose to pay out to their shareholders. Different companies pay different amounts depending on the company's own dividend philosophy and approach. The amount of shares you own will correlate to the dividends you receive. For example, there's a shareholder who owns 0.5% of Coca-Cola, and the company agrees to pay out $1 billion for the quarter in dividends. That investor will receive $5 million in pre-tax dividends for one quarter, just for owning the shares of Coca-Cola. Not a bad payout. Another positive would be to obtain voting rights. Just like how the amount of shares correlates to the amount of dividends you get paid, it also correlates to your voting rights power. And you can vote on how the company is run and influence decisions. The more shares you own, the more voting rights you have. This is important as it allows a more democratic approach towards decision making in order to do what is best for the company. The downside is that inexperienced shareholders may vote in a manner that can determine an important outcome. In summary, stocks have historically been a great tool for building wealth. Companies see the benefits of raising capital and reinvesting funds, where you can benefit from capital appreciation, dividend income, and having a say on how the company is run. But before you do choose to invest in stocks, do your own research. The more research you do, the more likely you will get the rewards you desire and meet your own personal investing goals. There will be much more information on investing in stocks and investing in general coming on the channel. If you haven't already, please subscribe, like the video, and of course, let me know if you like what you heard and if I've missed anything. Thanks for watching.